let me welcome on board Dipan Mehta as well. He joins in on the show. Dipan, hi, afternoon. Good to have you on the show. Dipan, seems like some healthy consolidation and much needed at that on the cards.
Yeah, good afternoon. Thank you for having me on your show. I don't know it's a consolidation or what, but it's just a continuation of the rally which we saw post the election result announcement, and the fact that investors are now convinced that NDA, will be also a solid government, and there'll be a high degree of continuity as far as government policies are concerned. In any case, all the key ministries are being headed by the same minister. So I think it's just going to be business as usual, and that seems to have been welcomed by the markets. Also, I think this recent number which has come in terms of mutual fund inflows, that has somehow enamored a lot of traders, and that kind of money coming into the market certainly is taking stock prices higher and higher, notwithstanding the high valuation. So I think we are seeing brute force of money coming into play over here. And as of now, it seems that there are absolutely no risk factors, although there always are. And this market can go even higher from these levels purely on account of the liquidity coming into it.
Point taken. So that's a view as far as the setup is concerned, more or less continuity in the government and more or less the expectation of the continuity of policies as well. In the meantime, just taking stock of some more big buzzers right now, and it continues to be those railway names which continue to do well, while oil and gas space has been a bit buoyant of late, but there are increased clamour that perhaps they have peaked out. Dipan, would you buy the argument that the profitability for some of those oil marketing companies has peaked?
No, I don't think that the profitability has peaked as much as I'm concerned about the valuations which these companies are trading at. And clearly they've got good earnings visibility. Railways is the focus area. Capital expenditure and then maintenance revenues are going to flow through to these companies. But look, they may be great businesses. They may be in a sweet spot also. But what valuation you buy them is very important if you want to really make a decent return on it. And right now, I think the valuations are pretty much well priced or overpriced zone. So I'd like to wait and watch 25-30% correction, and they may become attractive on a longer term basis.
Dipan, the last 1 week, I mean, from last Tuesday when you had the verdict, a lot has really happened in the market, a lot of chop and churn, that crash on Tuesday. Following that, previously, of course, was the Monday spike after the exit polls. And then from there, the markets have recovered all of their losses. In fact, made fresh highs as well. What exactly have you done in the last 1 week? Or have you done nothing at all?
No, we have been trying to liquidate positions gradually and get more and more into cash. I think that at these levels, buying into anything new doesn't seem to make sense, especially if it's a good quality business, which are all trading at very fancy valuations. So just waiting and watching, getting gradually into liquidity. Wherever we find the company numbers have not been up to expectations in the fourth quarter, we are kind of lightening our positions over there and waiting for a correction whenever that happens. It's not that we are going heavily into cash, but 15-20%, anywhere from 10 to 20% type of a cash in the portfolio is, I think, strategically important at these levels. And it could mean existing sales or fresh cash flow which is coming in, or fresh savings which are coming in, which one may want to invest in the market but are just putting a pause for the time being.
The latest coming in on some of these PSUs as well, and what Dipan has been doing in the last 1 week, trimming certain positions while looking at more ideas. But in the meantime, let's take it across to Sharad to get a sense as to what the chatter has been like in the dealing rooms today. Sharad?
Well, yes, in focus is JSW Infra, which is one of the largest private port operators in India. And what we are gathering from dealers over here is that a certain selling is coming across a couple of FI desks. Now, interestingly, 5 lakh shares have exchanged hands today also, and FIs are having roughly 2.34% stake in the company. And the key FIs already invested in the company, they include the likes such as Cohen Steers and Principal Financial Group. These are largely boutique to medium-sized FIs which would be in focus. Also, the likely buyer, what we are gathering from channel checks, is expected to be absorbed by domestic institutions, especially in the PMS category. Now, interestingly, we did do a valuation check of a 12-month forward EV EBITDA multiple. At that levels, companies coming at expensive 25 times, while you compare it with Adani Ports, which is coming at 18 times. Now, this was, of course, opposite when the overall JSW Infra IPO was happening, where the valuations were actually on the higher side when it comes for Adani Ports.
Right, okay, that's all the buzz across the dealing rooms. And just looking at the market texture right now, it's really been range bound. But yes, we've been making higher highs, like our chartists as well have been pointing out. And again, you're seeing that gain fizzle out. We're barely sitting on to a 0.2% kind of gain. 23,300 is where we're currently at right now in trade. Eicher Motors, Shriram, Bajaj Finance, LTIM, Ultratech, these are spaces which are looking good. But Dipan, an interesting development in the market, and especially within the auto space, the fact that Ola Electric, it seems, is going to IPO very soon, and they've got the go-ahead. There's Hyundai in any case in the pipeline. And then, the entire auto space, be it two-wheelers or PVs, has all been charged up, and I think CV plays as well. What is it that you make of this, new emerging opportunity within the auto pack now?
No, let us see what valuations Hyundai and Ola Electric come at. And Ola Electric will be on our market watch completely, absolutely on our list of stocks to watch quite closely, because that's the future of the entire EV space. And it'll start with the two-wheelers, and Ola Electric is the market leader over there. So I just want to see what valuations, and maybe not on at the IPO time, but post-listing, few weeks, few months later, understanding the company better maybe may make sense to buy at that point of time. But it's an interesting, investment theme to chase, and it's great that we are having such diversity and such new companies getting listed as well. So let's just wait and watch. Hyundai may be very interesting, but again, valuations are important. The only caveat is that if you read the recent retail sales, they have become negative for passenger vehicles, and overall industry has gone with that low single digit. Of course, a very bad summer is to be blamed for this particular low sales at the retail level. But I hope it doesn't become a trend, because in a way, what is happening is that the base effect of all these production and sales figures are also catching up. And just as we are seeing a mild slowdown in demand at the consumer level for a lot of big ticket items, something similar could happen in auto, and I wouldn't even rule out real estate. So on the whole, I think, industries, consumer-facing industries, which have had a great time last 2, 3 years or so, they could have a minor, demand bump for a few months or a quarter or two, and that may kind of, lead to negative sentiment. It could spook a few investors also. So I just want to be a bit careful when it comes to maybe auto or even real estate for that matter.
Okay, point taken. So that's a view on the auto sector. But we did speak with Jonathan Garner today of Morgan Stanley. He, of course, looks at the entire emerging market basket as well. Let's try and listen in, because it seems like they still have a tilt towards India. Just listen into a slice of the conversation we had with him earlier today.
When you look at the performance of the Indian market, really the last 2 weeks or so, it's quite encouraging. I know we had sort of volatility on the election results day itself, but what you're starting to see is India resuming its outperformance, particularly of China, and it remains our largest overweight in emerging markets.
Right. But Jonathan, tell me, despite all the positives, and not just now at the political front, but even if you look at the macroeconomics, be it the GDP growth, be it the tax collections, all of it, why is the FII and the FPI fraternity still sort of escaping India up until now? I mean, they're back, but just sporadically.
Yes, there have been sort of moderate, I would say, outflows this year. One does have to bear in mind there are other thematics that are very strong in Asian investment right now. So we are also bullish on Japan. A very different sort of story. It's really an ROE recovery story in Japan. But that has attracted very large foreign institutional investor flows. And of course, we have the AI thematic, which is highly investable in Japan, Taiwan, and Korea. I wouldn't read too much into the fact that FII flows are moderately negative. I think the support from the domestic investor is important in India, but we're also likely to get a structural upweighting in India by truly global funds over the next couple of years, now that India's weight in the EM index and global equities has risen so much. It's really quite a dramatic increase in weight. So those truly global investors are likely to be coming to India and buying, their first or second stock over the next couple of years.
Jonathan, when it comes to India, is valuation also a concern?
Yes, if you look at the outflows that you mentioned, that's more from the traditional emerging market Asia ex-Japan investor. And indeed, if you are a value investor, you would have a problem with the multiple that the market's trading on. But the point we make is that the growth multiple, i.e. around 22 times forward PE for MSCI India, is fully justified by superior earnings per share growth. MSCI India's dollar EPS has compounded 60 percentage points faster than overall EM in the last 3 years. So the farther out you look in terms of that forward multiple, the more, of course, it drops away. And we're really going through an unprecedented period of Indian earnings growth relative to, for example, China, where earnings have actually fallen in the last 3 years.
What is investable in India? Because, what all the domestic money has done is run up some of the small and mid caps, or SMIDs as we call it now, a little ahead of their valuations. We were just stacking up how much the market has recovered at just an index level from the Tuesday lows, which is just about a week from now when the election result was announced, and, the index tanked all across, and so did individual names. We're already up almost 20% on the small cap index alone, 15% on the mid cap, and 10% on the Nifty too. So where is it that you do see investable opportunity when it comes to India?
Well, for our clients, they're inherently more interested in big cap because they obviously have a lot of money to deploy and they need that liquidity. So we like financials, consumer discretionary, industrials, and also real estate, where the market cap is maybe not so large. So some of the names that we recommend include ICICI Bank, Maruti Suzuki, Godrej on the real estate side. There's quite a broad array that you could invest in, but the key theme is really to go for the domestic.
Okay, so that's the latest commentary coming in. Yes, India is slightly expensive, but nonetheless, given the growth prospects, remains a favored place to park money into. But for the time being, in terms of the market setup, it is really more of the same. I think we've just managed to ebb off a bit further. So we are at 23,321 but for what it is worth, at least 300 is being held right now, though the Bank Nifty too has given up most of its gain. At one point of time, it was above the mark of almost 50,000 points. But they've been talking about the pharma space specifically because that is where some of those ideas were emerging. Now, there's always the valuation conundrum when it comes to the healthcare side of the business, but within manufacturing, CDMO, API players, is there anything that stands out?
No, I think that pharma is a great defensive industry to be in. And last couple of quarters, the numbers across the board have been improving, largely because of lower competitive intensity in US generic market and overall improvement in exports globally and better compliance or regulatory management as far as US FDA is concerned. So it's one emerging industry. It has been a laggard for many years until about a year and a half ago or so. And I think it's ripe to take leadership position and show outperformance. So very positive on pharma. And depending upon risk appetite, I think the large pharma companies, Dr. Reddy's, Sun, Cipla, they all could give good returns. And the more riskier plays would be something like a Kaplan Point or Ipca Laboratories or Ajanta Pharma, all of which have got very strong emerging markets or rest of the world business, and have got some interesting products in the US generic space where their presence is still little small, and they can certainly grow that over there. Specifically, Ipca, I think they have got that Unichem Laboratories acquisition, which if that works out well for them, then it could be a growth driver for that company. But on the whole, very positive on pharma. Across the board, I would say, even turnaround stocks like Gland Pharma, Piramal Healthcare also look quite interesting. So lots of choices are there, but I think it's one sector one should get gradually overweight in.
Liquor stocks of late has been doing very well. Of course, Som Distilleries is an exception today. The state of Telangana has cancelled the process of registration for Som Distilleries after the allegation against the liquor firm. But that aside, most of these names, be it a USL, be it a Radico Khaitan, Tilak Nagar Industries, have been seeing a lot of interest of late, and they all have been sitting pretty much around their life highs. Naresh, we've been tracking the charts of both Radico as well as USL too quite regularly. What do you see? Can today's dip be bought?
In terms of United Spirits, the stock has finally broken out after spending months around that 1150 mark. So the breakout is done. Closer to 1250 should be a good support going forward. So a dip, the current dip between 1250 to 1290 is a good zone to accumulate the stock. Now, Radico, on the other hand, has gone sideways for the last almost 6 months. I would wait it out. Once it breaks 1750, that's the time one would look to get into it.
Okay, point taken. So that's about the liquor stocks. But in the meantime, cement has been the one space which has been also getting a lot of investor attention. Maybe the demand momentum is back, and that's visible with the price uptick coming in. And at least that is what the channel checks from Motilal Oswal suggested, that there has been a price uptick in the month of June, anywhere between $8 to $10. We'll get those lines for you up on the screen. But Dipan, what's the view on cement? Worth a bet?
No, I'd be a bit neutral to underweight cement. There are reports that, first of all, because of very hot summer, the sales and the prices have taken a bit of a hit. And now we're entering the lean season as well. Monsoon, hardly any construction activity takes place. At the same time, I think rapid expansion of capacities across the board still continues. And I know that the demand is great, and real estate, infrastructure, road construction, all are doing well. But end of the day, these are physical businesses, and with so much of capacity coming into play, I just want to be a bit cautious. But I've been proved wrong on cement. At least I was very impressed with the numbers which came from Ultratech as well as Shree Cement. So, I mean, I would just wait and watch as far as cement is concerned. And, let's just see how the actual expansion plans play out. And also, I think to an extent, they may get hit by high raw material prices, and some of the cost benefits may not be sustainable. So I would be a bit underweight to neutral as far as cement is concerned.
Okay, Aditya, let me just get in some BTST ideas as well from you before we wind up.
So it's on the cement pack. Actually, I was looking at the cement stocks itself because they're buzzing. ACC is looking very interesting to me, Aisha. So maybe one can go ahead and go long on ACC cement for a target of 2750 on the upside with a stop loss at 2560 on the downside.
Okay, that's BTST trade on ACC. Naresh, what about your BTST ideas?
So first would be a buy on IEX, which has given a breakout, stop loss at 169, target price of 178. Second would be buy on Shree Cements, which has continued the momentum after the breakout. A stop loss now at 27,400, target price of 28,000.
So cement remains to be a consensus pick, at least between the technical experts, though Dipan was not as enthused by the entire sector. Dipan, on that note, we'll let you go. Appreciate you making time and speaking with us. But it seems like Moody's and ICRA both are quite positive about the growth momentum as far as the banking sector goes. Here, an excerpt of the conversation my colleague Aishwarya Patil had with the representatives of both Moody's as well as ICRA.
So I think from a banking sector perspective, what we look for is a political continuity, and economic policy continuity, and to an extent, incumbent government is back in place. We expect the same to continue. So on a wholesale side, we think that there would be some more thrust in areas like infrastructure, manufacturing. The climate change is a big issue, so the whole transitioning is likely to happen. And also, we think the financial deepening story, which is giving more credit to the SMEs and the retail sector, is likely to continue.
Largely the same. We expect continuity in the policy directives on the financial sector. So to that extent, we do expect the government's focus on housing and infrastructure to really continue, which would mean, some way you would have to use the banking system to ensure that you are able to pass on or at least continue on those initiatives. So as such, we're not really expecting any major detour in terms of the way forward for the BFSI sector as such.
World Bank has recently said that the growth will continue at about an average of 6.7%. What are your thoughts on that as well?
So I think if you really look at from a global setup, for banking system, what really matters is the nominal GDP growth, because that is tied to the credit growth in India. And our view is that if you look at the nominal GDP growth from a perspective, India would be 10-11% kind of a growth story for extended period of time on nominal GDP basis. and which will give banks ample opportunity to finance this growth, and the profitability of the sector has also improved. So it would be not only growth but with profits. Now, if you just contrast it with what is happening globally, you would find a lot of banking systems are facing challenges. So in Europe, we have a negative outlook on a lot of banking systems in France, in UK and in Germany, because of the tight monetary policy, the economic growth has really suffered. Similarly, in US, the whole commercial real estate market is suffering because of policy tightening, and which has implication for the banks. And China has its own set of problems related to deleveraging and property sector and so on and so forth. So if you marry the growth dynamics in India along with what is happening in the banking sector, it really stands out as an outlier.
Your thoughts?
As I said, in terms of GDP growth, we do expect the country to continue in 6.5 to 7% kind of growth rates for next couple of years. So that would definitely give a lot of opportunity for the BFSI sector to expand on credit. And as Amit said, the banks and the non-banks are possibly at the best of their financial health over the last 10 years. So that should provide them equal and more than equal opportunities for them to cherry pick and continue on the growth path with fairly strong profitability and asset quality numbers.
Okay, that's Moody's and ICRA speaking with ET now. In the meantime, we're headed in for a very, very quiet close. It's almost a mirror image of yesterday, wherein, irrespective of the highs and the lows of the day, we close in absolutely flat, and that's exactly what's happening. Barely in the green, less than 50 points, 23,300 those sticking by. Power Grid, SBI Life, iShares, TechM, Shriram Finance, Bajaj Finance and Coal India, of course, have been your movers. But on the dragging end, look at the swift slide that you've seen in M&M. If we can just bring up the intraday graph of that stock, because I'm not quite sure whether it started off the day as weak. It did start off well in the green, but in the last 1 hour, you've seen the stock cool off quite a fair bit. It's closing in pretty much at the session lows. 46 points lower, 27.87 is where it's shutting shop for the day. But yeah, FMCG as a pack has been quite the laggard. So Britannia, Unilever, Nestle, etc. have all been laggards. So has ICICI Bank.
If you like this video, then like, share and subscribe to ET Now.